Hello, this is Professor Randy Minton from Thomas University, and I'd like to welcome you to a video over unearned revenues and their adjustments as an adjusting entry at the end of a period, an accounting period. And in this particular instance, let me just point out something that is generally true. With companies, they very rarely will have this mistake because that is the mistake of not doing the adjusting entry. And the reason that they won't have that mistake is because they're actually moving money from an unearned or liability revenue account to a revenue account, which is an earned account. So typically, if anything happens, it is that they book too much of the unearned revenue to revenue as opposed to too little. But that's another story for another time. At this point, let's talk about an ongoing adjustment that we would be making at the end of every month to cover a series of unearned revenues. And in the example that I'm giving, let's assume for a second that we are a professional basketball team that plays 82 games, 41 of which would be at home. And so the total games to be played in this case would be 41, because we don't get to collect revenue for any game that's played on the opponent's court. So we're only collecting revenue from games that are played on our court. And we have an obligation, therefore, to play 41 games in order to earn this $4,100 in revenue. And of course, the revenue then is simply the division of 4,100 by 41, giving us $100 per game. So now what we have to do is look and see. Now this was the money that we received from our ticket holders, season ticket holders, and we received it on December the 1st of 2015. So we got $4,100 from them, and now we're going to go through the month of December, and we're going to play, let's call it 13 games. So if we play 13 games at $100 a game, then we would have earned $1,300 in the month of December. Now, what happens with that $1,300 is it goes to the debit side of the unearned revenue account. Originally, it's a credit because the original entry would have been something like cash $4,100 debit and a credit to the unearned revenue account, which is a liability in the amount of $4,100. Now we have earned $1,300 by playing 13 games at $100 per game. So I would have a debit now going to the unearned revenue account. Why? Because unearned revenue is a normal credit. And to make it go down, we have to debit it. We have to do the opposite to it. The credit in this case will be to the revenue account. And the revenue account will have earned exactly the same amount as the unearned revenue account will now have given up. So the balance now becomes $2,800. The entry that we would make would be a debit to unearned revenue at $1,300 and a credit to revenue at $1,300. And now the question is, what happens if we don't make the entry? Well, if we don't make the entry on the balance sheet, our liabilities are overstated because we have actually earned $1,300 worth of revenue. So since it's overstated, the stockholders' equity side will be understated, because remember your basic accounting equation of assets is equal to liabilities plus owner's equity. So therefore, if you have an overstatement on the liability side, you have an understatement on the stockholders' equity side. Now, what happens on the income statement? Well, revenue would be understated because you would not have made the entry here crediting revenue. Revenue is a normal credit balance, and it goes up when credited. And in this case, we would not have credited it if we hadn't made the entry, so we would have understated the revenue. And since revenue and income work in exactly the same direction, we would have also understated the income side. Okay? Now, after we posted this entry, we would have a balance left in our unearned revenue account of $2,800. So then that, by the way, is reflected over here, and then the revenue side reflected here. Now, eventually what will happen is this $4,100 will all disappear, assuming we play all 41 games. That amount of money will all disappear and become revenue. So let's see what happens. Let's go forward here. In January, we now play 19 games. So when we play 19 games at $100 a game, we earn $1,900. So that $1,900 then would be reflected in the following entry: unearned revenue debit, to make it go down, because we've now earned some of that revenue, and revenue credit, which makes it go up, the revenue account go up by $1,900. Here's what it looks like on the T accounts. $4,100 to start. We earned $1,300 in December, another $1,900 in January, and leaving us with a balance currently of $900. In the revenue account, we would have earned, as I said, in December, $1,300 and another $1,900 in the month of January. So we have at this point $3,200 of the $4,100 earned, and we have $900 still unearned. Okay? Alright, finally then, we play the remaining games, which my math serves me right is 9, in the month of February. Well, that means that, I should have said February here, not January. We would have had $900 that we would have earned in February. And again, let me just change this while I'm here. And that $900 would be reflected over here as a debit to unearned revenue, which is also reflected down here in the entry, and a credit to the revenue side, which is reflected right here as well. Again, what happens if we don't make it? Well, exactly the same thing that would have happened in months 1 and 2, or December and January. The liabilities would be overstated and stockholders' equity understated. So if I overstate a liability, because remember, the accounting equation says that assets is equal to liabilities plus owner's equity. So if I overstate a liability account, any liability account, my stockholders' equity would automatically be understated. On the income statement side, revenue and income always work in the same direction. Remember from the previous example, if you looked at the prepaid accounts, you would notice that we had expenses that were understated if we hadn't made those entries, and expenses and income work in opposite directions. In this case, we have revenue. Revenue and income always work in the same direction. After we've posted this to our accounts, you'll notice now that the $4,100 has returned to zero. Why? Because we have earned all $4,100. We've played all 41 games at $100 a game, reducing the unearned revenue to zero. And in its place, we now have revenue of $4,100. So basically, we've swapped the $4,100 unearned for $4,100 earned. So, I know that's a very fast overview of it, but if you want, you can kind of go back and replay the video again and see how it all works. But that is the video for unearned revenue. Thank you for your time and attention.